Hey everybody, welcome to Trading Capital's exclusive analysis. In this weekly sector review, we're going to be discussing all of the sectors of the S&P 500, starting with XLB materials. So materials have actually been a very strong standout sector. I've talked about this as saying that materials are one of the least overbought sectors, even though it has had a very strong and meaningful move to the upside. This sector is on watch for a larger term breakout. Now, first things first, there is the inverse head and shoulders pattern that is on watch for a trigger. If you're doing it more from a more consistent point of, or a more conservative point of view, you can just say that you haven't actually triggered the neckline, although some analysts would say you have triggered the neckline. I'm going to give the pattern for the benefit of the doubt and use this major pivot and say we have triggered the inverse head and shoulders breakout on materials. Now, the big thing is that obviously if we use that upper boundary trend line, you can see that we're right at that area. So let's leave both trend lines on and let's just draw in our second component trend line, and basically the bulls will remain in control of this pattern as long as we stay above this lower boundary pattern. I'm not a buyer of this pattern yet, I'm just a watcher, and I'm looking for a retrace back to this area to look for it at some individual weekly longs. So this you can see on the weekly chart, we have had a nice reversal off of that resistance. You did get a weekly reversal. The volume is light, so it's not really that concerning at this point in time, but it did get a weekly little hammer candle there, which closed below the previous weekly high close. So have to watch this for further downside, but you can technically buy this pattern around that low 83s or this trend line of support. Let's move along to the next sector, which is XLC. Communications got that weekly breakout last week. They have not confirmed. Communications have not confirmed. They did get a higher daily and weekly pierce of that previous high, but they could not close above it. And in fact, they managed to close the week just down on the session. What was on the week? Actually, they closed the week still positive, plus 0.07%. So even though you did get a nice little weekly reversal, this was a positive close yet again of the week. Still never got that confirmation because you closed below this wick. So right now, the XLC is still very extended. There's still a potential move that it could get all the way up to about 76 here on the session charts, but the weekly close above this previous wick high will tell us more for the bulls. But as of now, I'm still expecting a retrace into this vicinity, call it about mid 70s on XLC. If you stay above these two trend lines here, that bodes well for bullish consolidation and a continuation move higher. But right now, this pattern needs to try to digest this move a little bit more. And again, the bulls want to really hold above these two trend lines. And if you can consolidate, then this pattern could be bought on a potential breakout in the communication sector. The one thing I will caution you is that communications, this sector specifically, is one of the most skewed sectors of the S&P 500 ETFs because it does have such a large weighting of meta. Let's move along to the next sector, which is energy, XLE. So XLE is right now, you can see this moving average in purple is the 50 weekly moving average. That's a big level for the energy sector. You can see we've been really fighting this resistance point for quite a few weeks here, and we actually got a huge reversal crushing below that moving average near the end of the week for the energy sector. So right now you can see energy sector still holding this upsloping support line. If you lose that area, this is triggering a little bit of a head and shoulders on the weekly chart because you have a lower left shoulder, a slightly higher high head, and then a lower right shoulder. So a break of this neckline opens the door for a big move down in the energy sector that we have to really pay attention to. And what is that? What could that mean? That could be meaning that oil is maybe signaling some continuation downside heading into 2024. I think that would kind of surprise a lot of people if oil's continuing to break lower and lower, which obviously would be great for the consumer and corporate America, but it really could be signaling something else or something greater for the overall economy. But watching energy, because this is shaping up to be potentially bearish consolidation. Right now, you want to give it the benefit of the doubt that it is holding the support trend line, but it certainly doesn't mean it can't break this area and go lower. But if the bulls try to recapture their weekly 50 moving average, I think that is your big level that you want to watch in the energy sector. Let's move along to financials, XLF. So XLF's interesting because it has had that stellar move up into a couple key resistance zones. If I were to zoom out on the chart, we have massive areas. You have this previous massive 2008 channel that we've chopped in from the high to lows for quite a long time. Then we broke out of that channel on a massive QE monetary stimulus worldwide and low artificial interest rates. And then once we went into that tightening cycle, trying to bring down that headline CPI, markets crashed, basically retreated to the center point of this channel, had that big rebound on multiple occasions off the top of that resistance. And now we're basically right at that same level here after we've been rejected here once, twice, three times, four times. We're right back at that same resistance. So, are we finally going to get through this time? Odds are that we see a pullback, but the bulls want to hold above 37 bucks if you start trending back inside this channel. It always leaves the vulnerability of heading right back down to these lows. We have a nice 3 triple bottom over here where you could connect an upsloping trend line of this magnitude, and that could be used as a little bit of a support. There is a weekly gap fill still at 31.47, but clearly there's a big risk to reward right now in terms of the downside, since we have been rejected here multiple times. Obviously, financials have done well because interest rates have certainly cooled off in the recent weeks, especially in the U.S. yield markets, diverging really from what the actual Fed fund rate is. All right, let's move along to the next sector, industrials, XLI. XLI is just a powerhouse beast of a sector right now. It is ripping across all time frames here. Weeklies, dailies, hourlies. I mean, it's just trending up and up and up and up and up. I mean, simply speaking, from this $96 level all the way back in October to about 114, 115 here in the end of the year. What a standout breakout, closing at some all-time highs here and holding them pretty firmly and strongly. Your big level on bulls, your breakout was this 106 in my opinion, where you had this little bit of a failed breakout, retested the lower range of support, support 1, support 2, support 3. You've had an epic bounce off that level. The upside of this pattern could still take you to 125. Do I expect it to get there in a straight shot? No, I would love to see a retrace. If we got a retrace, and I think there's possible, there's a lot of people that are going to wait for this level here, this first pivot, but I would like to see the second pivot struck for a potential bounce up here into the next leg higher. So I'm waiting for the second pivot bounce for potentially buying a long entry. I like this 105, 106 area. If we can get a retest of there, that's where I would be a potential buyer to go long in this sector. All right, let's move along to the most important sector, which is technology, XLK. So XLK, obviously, we've been watching for several weeks now. Well, I've been watching for a lot longer. Is this monthly trend line, connecting it all the way from 2000 to 2022. We broke above that. Now we have gotten a monthly break above that trend line. What you're looking for now for a continuation move is another monthly confirmed close. You need basically a close above 193.72 to confirm this monthly breakout. If you get that, this pattern is showing a great deal of upside for the next 12 to 24 months, maybe even longer. But a weekly close above that weekly high or above that monthly high is a bullish factor. Now, looking at the weekly chart, you can clearly see we're into some resistance. Again, we've had how many weeks in a row now? A record since what, 2016? 1, 2, 3, 4, 5, 6, 7, 8, and 9 weeks consecutive upside in a row. Absolutely outstanding, but you are starting to run out of momentum again. Daily chart has seen some downside. Weekly chart still holding up, but putting in a little bit of a doji candle off of resistance. Still getting a higher weekly close, so it's still showing net buyers, but definitely getting long and extended in the tooth on the technology chart and really tagging this resistance. The bulls would like to see a pullback into this weekly 50. Even if technology fell all the way down to 163, 165 area, that would still mean it's in a healthy, longer weekly uptrend, and it just would mean a digestion of this breakout pattern. So technology right now obviously is looking to continue higher, but in order for a continuous sustained move in 2024 to occur, you need to see some consolidation occur in the technology market, and first stop would be a pullback basically back to this pivot high. You can even extend your trend line back and you have it confluencing with these previous pivot highs over here. So your first big support is around the 180. Even if it retraces there, the trend is still fine over the longer term scale. But realistically speaking, the better trend to buy if we were to get a nice healthier retrace would be a retrace back down to the low range of this wedge pattern here. If you could get a move all over the next few consecutive weeks, a nice consolidation grind down, that would be a healthy pullback in technology. But this move right now is not is getting on the basis of extremely unhealthy and unsustainable. All right, let's move along to the next sector, XLP. XLP actually saw a little bit of strength on Friday and closing the week strong, whereas the rest of the market sold off. There were a couple sectors that were green as of Friday, but all the other sectors were red. Staples were a sector that showed a great deal of strength as the market was selling off. As you had the Qs, the Russell, and the S&P selling off, the Staples sector XLP closed at the weekly highs and the daily chart highs on Friday. So definitely some positive money flow into the end of the year. What could that be telling us? That's maybe telling us funds are moving more defensively. Money is moving to more of the less volatile assets. They're starting to trim profits potentially in technology and some of the high beta stocks, and they're looking for more of those defensive staple names. Potentially that's what we could be seeing as a money rotation trade out of some of the more overbought sectors that have had stellar gains in 2023 into some of these sectors that have had a little bit less great deal of performance. So interesting to see some of these individual names perform. I think XLP with that strong weekly close has a chance to retest this trend line now. You have a beautiful little trend line connecting from your all-time high pivot to your pivot in 2023. It confluences in around this $75 zone on the chart. So I think XLP has a great shot at moving up there. Even if the market starts selling off, the Qs and the S&P can still trend lower if mega caps see some money flowing out of them, some key names, as some of the other sectors start to perform a little bit better. All right, let's move along to the real estate sector, XLRE. XLRE on the weekly time frame, you can see it's just trying to trade to the top of this trend line. You're still below your pre-COVID high. This is your pre-COVID high waterfall sell-off. You're still below that. And notice where your last lower high was rejected. It was rejected right off of that zone. So mentally and technically, your pre-COVID high is your major resistance. That is the high that is really keeping this lower low downtrend in check, because this is your big resistance now as well as this. Keep an eye on that level, as well as a secondary intermediate resistance level, which is this parallel channel. You can see we've hit the low, hit the high, hit the low. Now it looks like we want to test the high of that channel. As of now, this is still consolidating on the weekly chart. I would like to see a couple more weeks, but the market typically doesn't give you those weeks when you're looking for them on a perfect pattern. So we'll have to watch for this for a breakout. Basically, anything inside of this green bar is still technically consolidation. If you were to lose this wide range green bar around that 37.75, this pattern could be vulnerable to breaking the $32 level and going to around the 31.80. I'm still looking at a larger term pattern. It has not formed yet, but if this were to break out, this could be having a massive left shoulder on your COVID bust. This could also be a massive head topping formation on your high interest rate hiking cycle. This could be an epic monster bounce, bear market bounce, so they call, that forms an epic right shoulder. It hasn't formed yet, so it hasn't triggered, but it's just something we need to keep on the docket as we move forward in the rest of this market in 2024, because this could be a monster shoulder forming in the real estate sector. All right, XLU, utilities. Look what utilities did. They did that weekly hammer reversal, and you've just been trending lower since. This could be just consolidating. You are below the weekly 50. That seemed to be a strong resistance point, so keep your eye on that weekly 50 moving average. But also, you're back inside this lower wedge pattern. You're trading at the high end of the wedge. So when you trade at the high end of the wedge, and you're getting rejected, there's always a chance that you could sell off and retrace at least 50% of this move, and potentially even more. There's always a chance to go back down to the low end of the wedge. Now, utilities are greatly affected by yields and interest rates. The fact that yields and interest rates have really weakened for the last several weeks and utilities haven't been able to break out leads me to think that if interest rates and yields bounce, utilities are likely going to sell off and get rejected off of this area. But The bulls need to watch for a little bit of a mini right shoulder. If you start to curl up here, then you could be forming a little bit of an inverse right shoulder. So a couple little patterns to watch here. You know, you are at resistance, but if this consolidates and forms a right shoulder, then you have a little neckline to watch for a potential bullish breakout to the upside, and that would be a pretty stellar bullish move if utilities can actually form that right shoulder and break out to the upside. Not my base case right now, but it's certainly something I'm continuing to keep my eye on. Healthcare was the other strong sector on Friday. Everything sold off except for healthcare and staples. So relative strength in staples, XLP and XLV, showing that money's moving more defensively, although there are some speculative high beta healthcare names. Definitely on watch. Look at this clean break of this trend line. Wedge pattern has broken out to the upside. This pattern is looking very powerful. This is basically almost a 2-year consolidation pattern in XLV, and you've now gotten a wedge breakout. But there's always a but with technical analysis. You haven't truly broken out of this trend line. Pivot to pivot to pivot, which says that there's likely a move that's going to happen to 138.75. You're probably going to see a move up into this trend line as if it's breaking out, then a pullback, and then you're probably your bigger breakout to the upside as long as the market holds. But definitely money looking to accumulate in XLV. Run through some individual charts and names. The sector and ETF doesn't really give you a good performance. There's going to be some individual names that'll actually way outperform the XLV ETF. So there's a lot of bullish catalysts that I'm looking at in some of the XLV sectors as I'm moving into 2024. So keep your eye on some individual names definitely, because this sector did see a positive weekly close and daily close on Friday when the broad market was actually selling off. All right, XLY is extremely interesting because obviously everyone's watching this massive weekly inverse head and shoulders breakout on the weekly chart. You did get the confirmed breakout on this chart, but now you're consolidating, and you actually got that weekly distribution doji followed by another down week. Odds are you get a pullback down to 172. You know, a lot of people are chasing and holding this breakout up here. They want to see this just continue and run to the upside, but I think we get a pullback back down to 170, 150-ish. And if you start teetering and losing this neckline, this could become a failed breakout. Obviously, we did get that golden cross. If you throw in the weekly 200 and the weekly 50, take a look at that golden cross that occurred. That's a beautiful bullish signal, which in the short term actually typically sees a downside move. So golden crosses actually get sold into, and then after a couple weeks the golden cross passes by and price action settles. That's when you typically buy. You never want to buy the actual cross. That is a rookie mistake. Often market makers know retail and other people are looking at this signal, they buy it and then they sell into it, and then the intermediate trend starts to take hold once people are underwater and shaken out. So typically these crossovers are never supposed to be bought when they physically happen. You're actually supposed to sell into it, and then after a few weeks of consolidation, that's when you chase that bullish signal. But it's a strong, powerful weekly trend signal that typically does yield positive results. For instance, if you were to short this bearish crossover here that happened where you had the weekly 50 intersecting with the weekly 200, look what happened. You short that weekly crossover there, you got one down candle, and all of a sudden, reversal, consolidation, breakout, you're underwater. So you never want to buy it, just like you never want to short it. Those are two signals you never want to do. So watching it closely, because this is a sector that's very powerful with the likes of Tesla and Amazon propping up this ETF. Overall, to summarize things, technology is seeing some distribution at the highs. Staples and healthcare are getting very powerful closes and looking like they want to continue higher. Same thing with materials and industrials. After consolidation and maybe a pullback, those are some very bullish sectors that I would keep my eye on. On that note, thank you all for tuning in. Please give this video a like down below, share the content, and hopefully everyone has found this weekly sector review at least a little bit helpful in the sense of tracking money flow and directional trends. Take care, everybody. Enjoy your happy new year, and we'll see you on the charts as we head into a new trading year and week.